Two out of three. $2 billion construction projects fail.
Which is just a staggering number when you really think about it.
Right. I mean, they go over budget, they run hopelessly behind schedule, or, they simply do not deliver what was promised to the owner. And the crazy part is the reason they fail usually isn't a supply chain bottleneck.
Yeah, it's rarely that.
It's not a sudden shortage of skilled labor, and it isn't a crane collapsing on site. The critical failure point is often sitting in a file cabinet in an insurance broker's office.
Exactly. It's the paperwork.
Yeah. So, welcome to the deep dive. Today, we are unpacking the hidden catastrophic risks embedded in the historic 2026 infrastructure boom. Because if you are a construction business owner looking to safely scale your operations and really become a legend in this industry, this is the battlefield you are stepping onto.
And it is a battlefield.
It really is. So our mission today is to figure out why these mega projects are more dangerous than ever and to give you a strategic playbook for protecting your business before you even think about submitting a bid on your next major project. We're pulling from some landmark research out of Oxford University today, along with urgent warnings directly from Liberty Mutual and market data from Smart Business Automator.
Yeah, and the contrast between the opportunity and the risk right now is, well, it's what makes this so critical. Because the scale of the work available in the infrastructure pipeline is unprecedented.
Absolutely.
But we tend to view insurance as this a static checkbox, like a frustrating cost of doing business.
Right, just something you have to buy.
Exactly. Rather than seeing it as a dynamic, highly specialized risk mitigation tool. And to understand why that mindset is so dangerous, we have to look at the sheer, unforgiving scale of the failure rate facing the industry right now.
Because the pipeline looks like an absolute gold rush. I mean, in the U.S., the Infrastructure Investment and Jobs Act is pumping $1.2 trillion into the market.
It's a massive influx.
Yeah, and up in Canada, there's $115 billion slated over the next 5 years alone. We're seeing these massive, specific greenlit projects, like the $3.6 billion Brent Spence Bridge.
Oh, yeah, that's a huge...
And the $4.6 billion Georgia SR 400 project. It just feels like generational wealth is waiting to be built. But the Oxford University research tells a completely different story.
It really does.
This study was led by Bent Flavjerg, and they analyzed over 2,000 mega projects. And just to clarify, these are projects with budgets over $1 billion.
Right. And the statistics from that study are genuinely grim. Right. So mega projects have a 65% failure rate.
65%? That's wild.
It's more than half. Mm-hmm. And across those 2,000 projects, the average cost overrun is 27.4%.
Wow.
And when you're dealing with $1 billion baseline, 27% overrun is $250 million in unexpected costs.
It's evaporating.
Right. And the schedule overruns are even worse, averaging 55% of the original timeline. I mean, imagine telling a stakeholder or a municipal government that a 4-year bridge project is going to take over 6 years.
Tying up traffic and capital the entire time.
Exactly. But the most sobering statistic actually comes from a joint McKinsey and Oxford finding. They found that only 8.5% of mega projects come in on budget and on time.
Less than 1 in 10.
Less than 1 in 10.
From more contractors than ever are mathematically guaranteed to get burned here. But I want to challenge the premise for a second, because I'm looking at this from the perspective of a contractor who, say, just flawlessly executed a $50 million highway interchange.
Sure.
I mean, a road is a road. Concrete is concrete. Why does simply adding zeros to a project budget exponentially increase the failure rate? It feels like stepping up to the major leagues, but swinging a wiffle ball bat at the massive scale completely changes the physics of the game.
That's a great way to put it.
But if I'm scaling up my operation, shouldn't the risk just scale linearly alongside my revenue? Like, what actually breaks first when you cross into that billion-dollar territory?
Well, what breaks first is the management of complexity. Because risk does not scale linearly. It scales geometrically.
Geometrically. Okay.
Yeah. When you go from a $50 million project to a $500 million project, you aren't just pouring 10 times the concrete. You're introducing entirely new intersecting timelines.
Oh, I see.
Like on a smaller job, if one shipment of structural steel is delayed by a week, you might just send a few crews home and adjust the schedule. No big deal.
Right. You eat a few days.
But on a mega project, a delayed steel shipment creates a catastrophic domino effect. The steel delay pushes back the concrete pouring, which delays the electrical contractors, which then triggers penalty clauses from like 3 different subcontractor unions simultaneously.
Oh, wow. Well, your municipal permits are probably starting to expire.
Exactly. The lines of communication jump from 50 to 5,000. And actually, Smart Business Automator's Market Intelligence Report flags a critical risk factor right now, which is the massive danger of a project's size relative to a company's actual capacity.
Right.
Because as more contractors chase these mega projects, they just assume their existing systems can handle that geometric jump in complexity.
Because you think you're capable since your leadership team crushed the last job. But the operational capacity of your project managers, your safety systems, your risk management protocols, they don't magically multiply by 10 because the contract value did.
They absolutely don't.
Which brings us to the specific hidden point of failure our sources highlight. When these massive projects go south, the fatal blow usually isn't a structural failure in the dirt. It's a failure in how the legal and financial risk was structured by the insurance broker.
Yes. And we have a very pointed warning on this from Aidan Lanzon. He's the Senior Vice President of Liberty Mutual Canada. So writing in Insurance Business Magazine, Lanzon states that mega project complexity is exposing general contractors to unprecedented risk. And his warning is specifically directed at what he calls generalist brokers.
Generalist brokers, so the folks who do a little bit of everything.
Right, the broker who insures your local office building, your fleet of trucks, maybe the strip mall construction down the road. Lanzon warns that bringing a generalist broker onto a multi-billion-dollar transit or hospital project is a recipe for absolute disaster.
Because they miss things.
Huge things. It leads to coverage gaps, inadequate surety bonding, and just catastrophic uninsured losses. He says you need to be very selective about your broker and demand to see their specific mega project experience.
Okay, but let me put myself in the shoes of the listener for a second. If I'm a business owner and I have a broker I've trusted for 15 years, someone who knows my business inside and out, who handled my $10 million jobs perfectly without a single hiccup firing them just because my new project is bigger, feels like a terrible business decision.
I get why it feels that way.
Right, because isn't insurance just insurance? As long as the coverage limits are higher, why does it matter who sells me the policy?
Well, that loyalty is exactly what bankrupts scaling contractors. Because insurance at this scale is not a commodity. It is highly bespoke legal architecture.
Legal architecture.
Yeah. Think of it less like buying a larger policy and more like engineering a physical structure. Your trusted broker is like a highly skilled residential plumber. They can perfectly pipe a 10,000 square foot mansion.
Sure.
But a mega project is a nuclear submarine.
Oh, wow.
The basic physics of water might be the same, but the pressure and complexity of the submarine will instantly tear the residential plumbing system apart.
That makes a lot of sense.
A generalist broker simply doesn't have the depth of knowledge or the relationships with massive global underwriting syndicates to properly structure a billion-dollar risk portfolio. Because mega projects involve massive design and engineering components that legally shift the liability directly onto the general contractor.
And we really see the result of that shift. Smart Business Automator's Market Intelligence Report shows professional liability claims in construction have increased 15 to 20% year over year since 2022.
Which is a huge jump.
It's a staggering jump. So if a generalist broker is using a residential plumbing approach on a nuclear submarine project, what are the specific failure points? Our sources break the required legal architecture down into 6 pillars of project protection. Let's explore the mechanics of these pillars, because missing even one can freeze a project entirely.
Yeah, let's go through them. So the first pillar is wrap-up liability.
Okay.
On a massive multi-party project, you don't just have your own employees on site. You have dozens, maybe hundreds of different subcontractor entities working simultaneously. Wrap-up insurance is designed to cover everyone under one umbrella so that if something goes wrong, you aren't stuck in a web of finger pointing.
So everyone is covered together.
Right. Because if a generalist broker structures this incorrectly and leaves a coverage gap, the real-world consequences are immediate.
So, let's say a Tier 3 subcontractor drops a steel beam and shatters a critical municipal water main, flooding the entire site.
Good example.
If the wrap-up policy has an exclusion your broker didn't catch, the subcontractor's insurance denies the claim, and your general liability policy denies the claim. Construction doesn't just slow down, it halts completely.
Right, in its tracks.
Because nobody is going to fund the $10 million repair to keep the site moving, while 3 different legal teams spend 2 years fighting over who pays. That is the actual mechanism of how a paperwork error physically stops a project and creates that 55% schedule overrun Fleibjerg's study warned about.
Precisely the mechanism. So that brings us to the second pillar, which is professional lines. And this directly addresses the spike in liability claims we just discussed.
The 15 to 20% jump.
Exactly. In traditional construction, the owner hires an architect to design it, and you just build it. But mega projects increasingly use design build or integrated project delivery models, where you, the contractor, take on the design risk.
Okay, so if the engineering team makes a calculation error and the HVAC system in a billion-dollar hospital has to be ripped out.
Standard general liability will not cover it.
Really?
Not at all. General liability covers bodily injury and property damage, not professional errors. You need specialized professional liability coverage, or your company absorbs the entire cost of the rework.
Ouch. Okay, moving into pillar number 3, environmental exposure. And this isn't just about spilling diesel fuel on the site, right?
No, it's way bigger than that.
When you're taking on massive infrastructure work, you are often dealing with brownfield or industrial sites. You start excavating for a new underground transit hub, and suddenly your backhoe hits an undocumented leaking chemical dump from the 1950s.
And the second that happens, the site becomes a hazardous materials zone. And this is a huge issue. Smart Business Automator's Market Intelligence Report identifies environmental liability claims as the absolute fastest growing category in construction insurance today.
The fastest growing? Wow.
Yeah. The regulatory fines, the mandated remediation costs, and the subsequent project delays can completely wipe out a project's profit margin overnight. A specialist broker ensures your environmental policy actually covers historical unknown contaminants rather than just the pollution your own machinery might cause.
Okay, that is critical. So the fourth pillar completely dictates your ability to scale, and that's surety and bonding. A surety bond is essentially a massive financial guarantee to the project owner that you have the capital and capability to finish the job.
Right. And if you walk away, the surety company pays to finish it. It acts as the financial oxygen of your business.
The financial oxygen.
Yeah, because your bonding capacity dictates the size of the projects you can legally bid on. A specialist broker knows how to sit down with surety underwriters, explain your specific operational strengths, and negotiate to maximize your bonding capacity.
Whereas a generalist broker.
A generalist will just accept whatever automated limit the computer generates based on a rigid financial formula, which artificially chokes off your company's growth.
Man, that's frustrating. Okay, then we have the fifth pillar, which ironically gets lost in the shadow of the massive liability numbers, fleet and property.
Yes, so often overlooked.
When a contractor scales up to a mega project, everyone gets so focused on the billion-dollar wrap-up policies that they overlook updating the baseline property coverages.
Because the equipment required for a mega project is entirely different from a mid-sized job. You aren't just bringing standard F-150s and common backhoes to the site.
Right.
You are bringing in highly specialized, custom-engineered tunnel boring machines or massive crawler cranes that cost millions of dollars to replace.
And if your property coverage limits aren't aggressively adjusted to match the actual replacement cost of that mega-scale equipment, a single localized fire or severe weather event in the staging area can cripple your balance sheet.
Completely triple it.
Right.
Which brings us to the sixth and final pillar. This is the ultimate separator between a generalist and a specialist procurement model expertise. The way a contract is awarded and structured fundamentally changes who holds the risk. Your broker has to deeply understand models like design build, public-private partnerships, construction manager at risk, and integrated project delivery.
Because different procurement models are like completely different casino games.
Exactly.
Design build is chess, P3 is poker. If your broker only knows how to play checkers, your entire company is exposed. Building a standard municipal bridge where you get paid as you hit milestones is entirely different from a public-private partnership where you might be required to partially finance the construction and then operate the toll road for 30 years to recoup your investment.
Right. If your broker treats a public-private partnership like a standard construction contract, you are entirely exposed. In a P3, you are taking on long-term maintenance and financing risks. In integrated project delivery, you are entering into a shared risk and reward pool with the owner and the architects.
It's totally different.
The insurance policy must be meticulously engineered to mirror the exact legal risk allocation of the specific procurement model. Otherwise, you have purchased a very expensive piece of paper that protects absolutely nothing when the legal claims begin.
So we know the 6 pillars that have to be covered. We know the mechanics of how these gaps physically halt projects. But our sources highlight a really fascinating psychological phenomenon regarding when contractors actually make these fatal errors.
Yeah, this part is really interesting.
Because it feels so counterintuitive. Usually we think of risk as something that happens when the work dries up. You would assume that business owners take on dangerous amounts of risk during an economic downturn when they are desperate to keep the lights on and keep their crews employed.
But Liberty Mutual warns of the exact opposite. They call it the times of plenty trap.
The times of plenty trap. So taking on too much when times are good.
Exactly. It occurs precisely during historic booms like the infrastructure pipeline we are in right now.
Yeah.
It is a phenomenon of operational momentum. When the market is flooded with federal and state money, your estimating team gets dialed into winning bids. The sheer volume of opportunities creates a dangerous institutional momentum. Estimators are working late into the night just to keep up with the RFP deadlines, and they stop pricing in the geometric complexity of the site logistics we talked about earlier.
So it's not about greed, it's about the machine running too fast.
Yeah, the machine just hums along.
You start bidding on projects in geographic regions you've never worked in, or you partner with Tier 2 and Tier 3 subcontractors you haven't properly vetted, simply because the contract value is too massive to ignore. The institutional friction that normally slows you down and forces deep risk analysis disappears because everyone is rushing to get the bid out the door.
That's exactly how it happens.
So how does a construction business owner recognize their operation is falling into this trap before they've already signed the dotted line?
You recognize it by auditing your own internal processes. You have to ask, are you stretching your bonding capacity to the absolute breaking point on a single project? Are you relying on the same risk management checklist for a billion-dollar transit hub that you used for a $50 million warehouse?
You have to step back and look at what you're doing.
Right, because the stakes here are monumental. North American construction insurance premiums exceed $30 billion annually. The Canadian surety market alone represents $4 to $5 billion. The margin for error is non-existent.
This is why our sources outline 5 highly actionable steps to safely scale your business without falling into the trap. Step 1 is the immediate stress test. Evaluate your broker's specific construction specialization. Do they intimately understand the difference between integrated project delivery and a public-private partnership? Have they actually structured the risk for a project of this magnitude before?
And don't just take their word for it. Step 2 is you mandate a comprehensive coverage gap analysis before bidding on any project over $50 million.
Before bidding.
This cannot wait until after you win the bid.
Right.
You and your specialist broker need to map every single risk category, from professional design liability to wrap-up exclusions against your current policies, to find the holes before you commit your capital.
Okay, step 3 requires incredible discipline. Know your bonding capacity intimately and follow the data-backed golden rule. Do not stretch beyond 60% of your total bonding capacity on any single project.
This is huge.
Why is that 60% threshold so critical for a scaling company?
Because if you max out 90% or under % of your bonding capacity on one massive, geometrically complex mega project, you have essentially choked off your own growth.
Oh, I see.
You have zero financial oxygen left to bid on the next potentially safer, more profitable, mid-sized opportunity that comes along. You lock your entire company's future onto the success of a single, highly volatile project.
That makes total sense. Step 4 is to get your environmental liability coverage specifically reviewed. Knowing that it is the fastest growing claims area, you cannot assume a standard pollution policy will protect your balance sheet from a 50-year-old toxic surprise buried in the soil of a brownfield site.
You need a dedicated, bespoke environmental policy.
Right. And finally, step 5, use this historic infrastructure pipeline to your advantage.
Yes. Insurers are actually looking to back incredibly well-managed companies that have a strong multi-year pipeline of government-backed work. If you can walk into a meeting with underwriters and demonstrate that you understand geometric risk, that your capacity is controlled, and that your legal architecture is flawless, you can actually use the massive scale of the IIJA pipeline as leverage to negotiate better terms and more flexible rates.
So you prove to the underwriting syndicate that you aren't just blindly chasing the zeros. You show up with a tailored, analytical approach to the realities of the site.
Exactly. You show them you're a safe bet.
So bringing this all together for the scaling construction business owner listening right now, the $1.2 trillion infrastructure boom is a generational opportunity. But raw ambition and operational momentum are not enough to survive it. Deep knowledge, meticulous preparation, and having an absolute specialist structuring your risk, that is the only thing standing between a highly profitable legacy project and a company-ending failure.
And as we look at the data, it leaves us with one incredibly provocative question about the future of the industry.
Okay, what's that?
Well, we've established that 65% of billion-dollar mega projects fail with massive cost and schedule overruns. We know that professional design claims and environmental claims are skyrocketing.
Right.
If this trend of geometric complexity continues to outpace risk management, what happens to this massive infrastructure boom if the global insurance market simply decides the risk is no longer mathematically worth underwriting at all?
Oh, wow.
Right. Will we reach a point where contractors have to pool their own massive capital reserves and entirely self-insure just to build the future?
That is a chilling thought. If the traditional safety net disappears entirely, only the most surgically precise, risk-aware companies will survive to build the next decade of infrastructure.
It'll be survival of the fittest.
Absolutely. So here's your immediate call to action to ensure your company is one of the survivors. Call your insurance broker this week. Ask them exactly how many billion-dollar mega projects they have successfully insured from ground break to handover in the last 3 years. If the answer is 0, or if they even hesitate, you are sailing a nuclear submarine with a residential plumber.
Yeah, time to upgrade.
Before you get back to the site, please take a moment to subscribe, rate, review, and share this deep dive with your executive team. And be sure to visit smartbusinessautomator.com for more insights. The 2026 infrastructure boom is waiting. With the right playbook, a true specialist broker, and flawless risk architecture, you can ensure that your company becomes the legend that actually succeeds. Thanks for listening.